Happy Saturday and welcome to another session of our RM Smart Investing Weekly Market Analysis. I hope you all had a wonderful week and enjoying your weekend. Today is May 20th. It's already May is almost over. And again, as always, we're going to go ahead and take a look at the economy, what we had last week, what we can look forward to this week. Analyze the markets, looking at some ideas about emerging markets I'd like to share with you. And when I say emerging markets, it has an international flavor, so not always it's going to be emerging. There's some I like to look at some maybe developed also overseas markets. Then we have a few lessons of the week. And this week, what I like to do, I'm emphasizing the trade of the week. So I like to share some of the trades that I did. I just want to show you what was my thought process. So we're going to spend a little more time than usual on the trades of the week. And then, of course, we have a screen of the week. So basically, there's 5 things I thought it would be important for takeaway from today's session. Would be, first of all, yesterday we had Chairman Powell came in the morning, around 8:30 our time, and started, talking. And a lot of Fed presidents are going around, and after their Fed decision. But that is important, and you shall see especially when we talk about the how the markets have reacted. So the other thing is about debt ceiling. As you know, like it was like Wednesday and Thursday, we have this positive feeling. The president is positive, the Senate leader Chuck Schumer and the Republican House leader, they're all saying that there is light at the end of the tunnel and the markets react. I like to look at some of the assets to see, are they really worried about this or are not, and how they are reacting to this. The third thing is I want to pay attention to these expected moves. It's just amazing if you just build your strategies around this and how the market really respect that. And I've been talking for the last quite a few weeks, actually, since the beginning of April, about this really gamma squeeze that we have to watch for with this large open interest. And whether it was this week, did we break it through, or are we still in that squeeze, that 4,100 to 4,200? Also, something caught my eye Tuesday night, and I will share that with you in our emerging markets, which I should say really international markets. Take a look at Japanese markets, and we will look at some of the charts. And last but not least, as I mentioned, I'd like to spend more time on this week on the trades that I did, few trades that I want to share with you again. What was, again, my thought process. So let's start with economy. As always, like to go under the hood and look at the some of the things that we might not notice it on the, you don't hear it on a daily basis from your financial news. Again, we are actually paying attention to these initial jobless claims. It is the parameter to see how is the direction as far as the employment in the future. So let's pay attention to that. We're doing better than month over month and week over week, but it is less than, or actually more than, a negative way where we are comparing to 2019. As I mentioned, box office receipts, there's more movies coming out. So let's pay attention to that. You can see there's 2 in a kind of a gray area here. What that means is these are the highest since the COVID era. So you can see every week, it almost like the global commercial flights are doing better and better. And the TSA checkpoint is doing better and better. Although we're still a little bit behind where we were in 2019, but this is the most we have done. And then the global is actually ahead of where it was. So that tells you that people are flying, there's activities, and that's what again, the airlines, they're still full, the airports, and also the leisure part of the economy, the hotels and traveling business, they're doing good. So The big thing we had last week, one of the most important was, again, the barometer for the consumers was the retail sales. So you look at the core and general retail sales. And it did bounce back. We were actually down in February and March, and we bounced back in April, rising 0.4%. That sounds good on standalone, which is usually seasonally adjusted, but the consensus was actually 0.8%. So there was a little disappointment there. Now, about half of the 13 major retail categories, they actually rose in April. The big one was non-store retailers, online shopping, internet, and mail order. Actually, even general merchandise stores like department stores and autos. Now, the largest decline was the gas stations, and not much in California, but generally you can see that the sales have not dropped for the past 6 months in a row and are down 14.6% from a year ago. Now, the core sales, they exclude the volatile categories like autos, building materials, and gas station. And they are important to measure for the estimating the GDP. They actually rose 0.6% in April, and they're up 5.2% from a year ago. Now, in the last 12 months, the overall retail sales are up only 1.6%. And that's what it's important, and again, related to the GDP and the health of the economy. This is the slowest yearly gain since the earliest stages of COVID. Now, on the other hand, the sales at restaurants and bars, that is in the service sector, it's only one, it rose actually 0.6% in April, and they're up 9.4% from a year ago. Now, that's understandable. Again, we're coming from the COVID, everything had, obviously the service was shut down. Now things are really moving. So, and again, a lot of consumers are shifting more of their purchases to services rather than goods sectors. So this is important to take into consideration. So next week, what we are looking at, on Wednesday, if you're following the UK market, then they have their inflation numbers, the CPIs on Wednesday. But in US, what I want you to pay attention is at 11 o'clock West Coast time, we have the FOMC meeting minutes. So the markets like to see that. They want to see what the thought process was during the committee meetings. So the other thing is the GDP, the preliminary GDP coming at 8:30 a.m. And again, that's also something that you want to, that's in New York or East Coast time, so it's 5:30 a.m. West Coast time. And on Friday, also the core PCE price index, the one that really fed the central banks, they paid more attention. As far as, again, we can see not much has changed. We're looking at comparing May 19th to April 21. Still got inverted yield curve. The spread is actually at 60 basis point. So, and as you can see now, the long-term rates, the 10-year notes, actually we've seen since May. We actually in last week, we will discuss that. And even since May, when you look at the UK gilts, they have been in an upper move. All right, let's take a look at the market. So a very interesting time. So what we had a move on Monday, and then, the banking sector. Then we have obviously this debt ceiling. I don't call it euphoria, but this positive news comes out. But the divergence really, when you look at the Dow Jones, was only up 0.38%, but NASDAQ was up 3%. Overall, the markets were up 1.68%, but which is very similar to S&P. But when we look at the large cap growth, the mega caps, they were up 3%, while large cap value was only up 0.45%. So you can see, again, we are still going back to these, I would say this FAMGA or the top 10 stocks are really pulling the markets up. As far as you can see that NASDAQ itself from its low of January 5th is up almost 23%, and we actually hit the 52-week high actually on Thursday. So you see it's only down 0.24% since its high. So so there's a really in the tail of two indexes, and then of course Russell had a nice bounce this week because of the regional banks bounce, but still lagging. So as far as the sentiment, that's also you see a divergence here. Now, as far as this comes on Wednesday, so it doesn't take that debt ceiling euphoria of the Thursday and Friday. So we are again going back to one of the lowest we've been. And as I've mentioned to you, that AAII, there are mostly seasoned investors. There are mostly retired, and they have larger capital than average investor. They're older, so they are more cautious. But now you can see the spread is almost again back to 17%. A lot of hold, but we are at 39.7%. So the bearishness has gone down tiny bit, but the bullishness also has gone down. Now, the fear and greed index, which looks at the 7 really internal market kind of orientations, it's not a survey, it is back to a little higher part of the greed. Last week we were at 58, now we're at 67. So it's moving up again. The positiveness and enthusiasm about the hopefully having a resolution about the debt ceiling. But don't use this much, that market sentiment, which is the Citigroup panic and euphoria. But you see that in the last 2 weeks, we've gone to more to the panic mode almost. Negative 0.4 and lower is really getting to the panic 4. And we are at negative 0.38. So that's something from the behavior finance it will be good to pay attention to. So let's look at the charts, and we've been talking about this again since April 1st for the last 7 weeks. We've been in a channel, a zone of 4,100 and 4,200, and where are we now? At 4,198. So basically the idea was, well, are we that mega squeeze? Is it going to go one way or another? And you can see we're still, when we look at 78.6, when you look at the Fibonacci, we are right against it. We did go hit it, and then on Friday we kind of retraced a little bit. So till we break through this, we still don't have the closure yet. Also, when we look at from the Bollinger Bands, again on Thursday we did go hit that upper edge of the Bollinger Band, and as you can see, the volatility had been very narrow. It's been coiling, and we just had a little bit of opening from the Bollinger Band. So let's see if it's going to open up and if we are going to continue. But we did touch it and we came back down a little bit. So we are in an overbought situation right now from the stochastic point of view. So we need another couple of days or so, see if we are going to continue staying in that zone and be embedded. And you can, again, MACD is pretty flat, which that tells you how narrow the volatility is. As far as going on a weekly basis, we still are under the 100-week moving average and against the Bollinger Band on a weekly moving average. You're getting embedded, on the other hand, on a weekly on stochastic. So let's see if one more week, and can we stay above this, or can we, if we break above that 200 moving average, which is about 42.61 or so, then all bets are off. That means that the momentum is on the buyer side, but we are not there yet. As far as NASDAQ, which has been the strongest, you can see that the volatility bands, the Bollinger Bands, have really opened up, and we are touching, just retracing a little bit. So obviously this has been the strongest. We are embedded. MACD is moving up. So basically that has been the strongest. Now, the word of caution, and that's when we would talk about interest rates. Now, the question is, we're getting closure with the interest rates. There's still a chance that the Fed will pause in June. And the interesting part is when the Chairman Powell was talking, the Fed watch of the futures, all of a sudden it jumped to the 40% of raising the rates, 25 basis point. Before that, it was like at 17, 18. So, and then toward end of the day, again, it came back to the 18%. So there's 82% there will be a pause. Now, the question is if the rates, and that's why we have to look at the interest rates and the 10-year and 30-year, how will that affect the big mega caps and the technology and the NASDAQ 100 as a whole? Right now, it looks like they don't care. There's no risk and they just keep moving up. And of course, another thing that you have to take into consideration is this, obviously, this, I don't call it euphoria, but a lot of enthusiasms toward AI. Some justified, some perhaps not justified, but we have NVIDIA, for instance, the numbers are coming up this week, which we'll talk about in the earnings, but the NASDAQ looks that, there's no stopping. So far they are looking bullish, and till there's something happens, they just continuing. But I just want to be aware of that. We want to watch the interest rates. And even on a weekly basis, I want to take a look at, you see, the only thing is we are right around the 100 weekly moving average and right against the Bollinger Band. Although I mentioned in the last few weeks, we are embedded. So on a weekly basis, MACD is still up. This is, again, another barrier that we want to break if there is going to be any momentum continuing. I want to add a third one for NASDAQ. I want to look at the Fibonacci. I did the two things. One, going back to the COVID time on a weekly, this is on a weekly basis, the low to the October, November highs of 21, and then to the low of 22. So I got two. And basically what I look for is a cluster point. So we had a cluster at, let's say, 38.2 on both of them. And that usually is a good spot for either resistance or support. And right now where we are, and that's something you want to pay attention, is that 50% from the high of October to the, that's high of November of 21 to the low of October, September of end of September, beginning of October of 22. You see that we are right at 50% zone. So there is that resistance. So let's watch that, and we'll discuss the debt ceiling a little more in our lesson of the week. So as far as the Russell, it had a nice jump again because of the regional banks, and now we broke above that 18-day moving average, but we are now in overbought zone and against the Bollinger Band. So it was a nice bounce, but when you compare it to, let's say, NASDAQ and even S&P, we haven't done anything and it has been suffering. So basically, I see some patterns here that we will discuss it in our candlestick patterns. So it makes it a little easier to understand what's going on. But anyway, so we are not out of woods. And of course, we have the 100-day moving average, a big resistance ahead of us. As far as the Dow is right around its 118-day moving average. Momentum has turned up, but we are not completely positive. We are still under 50. We were oversold last week when we talked about this. And so we bounced off the Bollinger Band, but now we are against that 18 and 100-day moving average. And the transportation, same thing. We just, very similar to Dow, we are under the Bollinger Band and the 100-day moving average. As far as the VIX. So you're looking at this, the VIX, and we've been talking about this. The VIX itself, when you look at this, they don't seem they're nervous about the debt ceiling. Now, I know the markets are, and when we look at, let's say, the volatility of VIX, there is some hedging going on, but there is still complacency. So again, we've had many occasions in the market thinks that, well, this could resolve itself like any other time. The danger part is, again, if it does not, it will affect the liquidity of the bonds. It will affect the other markets. It will the ratings of the whole U.S. economy, and basically those are the concerns. But the VIX itself, it's not telling us, and that's the reason it looks like, well, S&P is in its own world and it's doing well. But as I mentioned, you can see the VVIX is things are happening. But when we look at the interest rates, as you can see, they've been nervous in a sense. So although we had a lot of positiveness, but the bond market as a whole, you can see that we broke through that 100-day moving average. We are oversold right now, but it looks like it might be embedded. MACD is down, and there is a little bit of nervousness. So this higher rates, as I mentioned, would that affect the NASDAQ? So again, how far can we go up in the rates before there's a little nervousness? So as I also mentioned, there's that pause that the market for a while thought the interest rates are going to go up in June. So maybe that's part of that. But anyway, we are oversold at this moment, not embedded, but both 30-year bonds and the 10-year notes, they broke through that 100-day moving average. And what consequently happened to the dollar is, you can see again in the last few days with the higher rates, it has helped the dollar. And that has, we broke over the 100-day moving average. Now we're becoming embedded with the dollar. And consequently, the euro has broken below the 100-day moving average. So there's all these relationships. I will discuss in the lesson of the week. I know most of you are familiar with it. You do follow it, but sometimes we overlook it. I will share a chart that I have, but it is important to pay attention that there is this relationship of intermarkets. So nothing is absolute on its own. So, and by understanding these, you can actually come out with a better probability trades. And we just talked about the dollar, and dollar goes up, and what happens to the gold? The gold has been going down, dollar retraces, and gold goes up. I want you to pay attention to this 100-day moving average. And you can see on Thursday, we did go and touch the 100-day moving average. We were oversold, although the trend has come down in the MACD. But in the last few times, anytime we hit that 100-day moving average, we have bounced. So this time was not an exception. The question is, how strong a bounce will this be with the other things going on? So that 18-day, we might touching that Bollinger Band, being oversold, and coming off at the 100-day, there's a good chance we could go to that 100-day moving average. But in the short run, there's the buyers are being a little cautious, again, playing the dollar at this time. Silver did the exact same thing, had a bigger sell. As far as last week, we had more momentum on the sell side, but then we went and stopped right at 100-day moving average, except we're becoming embedded in silver. So let's watch that. It might not give us a lot of momentum for a retracement. As far as copper, Again, last week we talked about China's story from technical point of view. You see that 18-day, which is a downward 18-day moving average, is providing a resistance. So till that resolves itself, basically, and I've said it before, not moving averages, not necessarily the price has to go touch the moving average. Sometimes the moving average come and touch the prices. So this is the downward, the slope is down, except the thing is we are on an oversold, so we might have a little bounce, but still there is negative momentum going on, as far as it is more of a big picture with the economy, and again, China's story definitely. As far as Bitcoin, again, it has its own story and what is happening with the dollar and everything. So we have been sitting right under the 18-day moving average. The good news is we are above the 100-day moving average. We are still a little oversold, but the MACD and momentum is still down. As far as crude oil, very similar to the copper story, although the momentum we can see is actually positive, and MACD is trying to break the momentum and go to the positive momentum. So let's see how it happens, although we are in a downward momentum, moving average of 18 days. So it's been providing a resistance. So whether this resolves itself and we can go back at least to the 100-day moving average, which also is the upper Bollinger Band at 70, 680, 64, 84, it's almost $77. It remains to be seen. So with that in mind, I mentioned, let's pay attention to this expected move. I know I repeat myself, but again, it can tell you that how the markets are work very hard in actually as far as the trades go, and anticipation of where the prices will be. And that's, again, that there are billions and billions of dollars of options market are playing this. So it's really it's important. I mean, money is being gained and lost. So what happened on SPX, we didn't do much, and then Wednesday we had this breakout, and then Thursday we had almost looked like maybe this is the gamma squeeze. We are going above this. Maybe we're going to continue. This is what we've been talking about, that 4100, 4200, 4210 zone. And then Friday we just come back and just close right on the upper edge, right to the point. It was at 41. I think it was at 4111 or so. So we just right there. Of course, QQQ, as you know, had a great week, and we broke above that, and we had a little retracement. So this is another standard, like we are in the 2 standard deviation, even more, and we hit the all-time, 52 weeks high on the NASDAQ. So those are the things that, as I mentioned again, is when you look at Apple's, there's a gamma squeeze, is it breaking out? There's Tesla, there's Google, Nvidia, Meta, Microsoft, Amazon. So they're all, if you look at their expected move, they've all had the squeezes and broke out. So that's one of the reasons QQQ is staying outside its expected move. But other than that, you see that Russell, which had a nice week, it goes outside and came right inside this expected move. And the same thing happened with the Dow. Hit the upper edge and came back inside. Now, the bonds, as we mentioned, the interest rates, we got to be careful with that. That obviously, it has the inverse of NASDAQ. And that's what I'm a little concerned for now, from the fundamental point of view. How much of a divergence could we have? As far as the dollar, again, dollar was strong, and we did go outside the expected move a little bit, and then Friday we closed right inside. Gold did the opposite. Remember, gold hit its 100-day moving average, and so we were outside and thinking, well, is this going to be a squeeze and it's going to then fire up as far as the squeeze goes? And no, comes back right on the edge of its lower expected move. Silver was stronger, so it did go to the lower edge and bounced back. And then financials had a very good week, and relatively speaking, and they did go outside. And where did they close? Right on the edge of the upper expected move. I mean, you cannot make this up. I mean, you see it's Friday and it closes right there. Energy stayed right in the kind of a mid-range to the upper edge, toward upper edge. So, all right, I hope that was helpful. So a few things, again, I call it emerging markets, but let's call it international markets. Basically, the week that we had, this is as of Wednesday, there's a few negatives, especially in the Asian markets. And we see overall, Turkey was up a little bit as of Wednesday, but we'll discuss that. But year to date, we see a lot of green. Again, Europe's still strong. Turkey, we'll discuss about elections. And then Malaysia and Thailand, and they had their elections as well. So, but on that, you see Mexico, Egypt. So the markets have been doing well internationally. And again, this is as a reference. I'd like to leave this with you, whether you're looking at Brazil or we are looking at France or Germany, or as a whole, the global, the world index, just visually to see what is happening all of a sudden in China. And we go and compare that, for instance, what is going on with the bigger picture of IFA, or look at Germany, for instance. So just a few charts that I'd like to have. So here's, I'd like to talk about Nikkei 225, which is the Japanese large cap, or the major index. So it's Tuesday night, I mean Wednesday, yeah, Wednesday night. And I'm watching the market. I usually look at different things, and I love to go to Finviz, just look at the general things. And then I noticed this. I mean, at that moment, Nikkei hit 30,000 to the dot. And I took a picture of that. It was amazing how the round number. Now, the round numbers could go, could create resistance, could be create support. So it's important. There's a pause. So I'm watching that to see which way it will resolve it. Would we come down, or again, this is, as you can see, 6:19 p.m. West Coast time, so Pacific time. To make it short, so that was what happened on Wednesday. And then I know some of you are too young, probably remember it was, you know, the Japanese market has been in a no man's zone in a sense since 1990, 89, 90. This is what they did in the 70s and 80s. This is what Japanese market did. They went from 8,000 to almost 40,000, which was about 39,000 and change. And then the whole bubble burst. There was a real estate bubble, and they were using that, really the wealth, which really helped the stock market, and they were buying everything. I mean, nowadays people talk about China, you know, when we had the financial crisis, and it said, well, Chinese are buying real estate, especially in California and Vancouver. In 1980s, it was Japanese, and it was, you know, from Rockefeller Center to, I mean, any type of a landmark buildings, they were just buying them. And basically, then we had this collapse. So the reason I'm sharing this with you, look how what they have done. They've been in a deflationary period for many, many years. They have new head of their central bank, prime minister, and finally, since again we bottomed really, and you look at it 2014 or so, and now we have this leg up. And this is the highest, you go back, we've been from since early 1990s. And that's why I want to pay attention. Is Japan in again, after this consolidation, what happened? Is this something you should consider? Because they've had this deflation for so long. They've been devaluing their yen, really negative interest rates, 0% interest rates. So just a food for thought, more of a longer term. I just thought this would be good to see it since 1950s where they had been. On a shorter term, when we look at the Bollinger Bands, you can see how nicely we hit that 30,000, and we are at like 39.85. We hit the 31,000, by the way. The high was like 31,005. So in a couple of days, we actually went up almost another 3.3%. The beauty of this is, one thing about Bollinger Bands, it doesn't necessarily means negative. When we hit the upper edge, generally that means some of the buyers will take their profits, but that doesn't mean they're short. So when you have been in this consolidation and in this situation, but we've been above that 18-day moving average, when you have something like this, that shows you the momentum and strength. And I call this, when we see these candlesticks right around the Bollinger Band, we go outside, they come inside, and that's my railroad track. And railroad track can continue. They just hug that line and they just can go, and that shows the strength. So we are embedded. So just a food for thought if you're thinking of Japanese market. So I thought that was just interesting. Just a food for thought. We talked about Turkish election last week, which what happened is they're going to go to runoff. Erdogan did actually better than expected, but still was under 50%. I think it was like 49.4. So kind of surprised, but of course, there's this talk of, not all the votes were counted. And, there's again, same things happening there. The talk of that. So, but there is going to be a runoff on May 28th. So we have their friends. Greece has election on Sunday. One thing you can see, there was a coalition, but at least when you think about the center-right government, in 2019, they had 53% of the seats won. Right now, based on opinion, they only got 38%. So you see this huge coalition, which usually doesn't bode well for running a country. I mean, it looks like democratic, but nobody can make a decision. So there's a little nervousness. So based on that, I want to share with you, this is Greece ETF, if you want to follow it. It's called Greg. So it has been very interesting, like last year or 2 years ago when we had this shipping industry, it was doing great. That was awesome. The Greek markets did very well because they're the largest as far as the holders, or a lot of companies, shipping companies are in Greece. So, but right now we are in a channel. So, and now we are hitting a wedge here on top of that. So just a food for thought. They're up 20% so far year to date. But just be aware that tomorrow there's that election. So just a food for thought. Another thing on emerging markets, we talk about the sovereign debt, we talk about liquidity, and that's another problem with this debt ceiling. I mean, what the Treasury is going to do if they have to create more debt, and again, that creates as far as the liquidity problem. So what is going to happen in a sovereign market? So I thought this is an interesting graph of countries who have a high solvency risk, but the low liquidity risk. So like Brazil will fall in that category. But then we have high both solvency and liquidity risk. We go quite few African countries here: Mozambique, Egypt, Ethiopia, Rwanda, Kenya, Tunisia, but also some Central Asian, such as Mongolia, and then we have Jamaica. So, and then we have low solvency, but and low liquidity risk. So these are usually, last week we talked about the Persian Gulf states, the Gulf states. So you can see Qatar, Kuwait, even Iraq is part of that, and United Arab Emirates. And then we have low solvency risk but high liquidity, and that Croatia, Chile. So anyway, just if you are interested in looking at some of the emerging or frontier countries, I thought that would be helpful. Another thing is, again, with talking about electric vehicles and interest in lithium, just want to compare 2021 to 2022. You see the production mainly comes from Australia and Chile, and some from China and Argentina. So Australia had 52% of the production, and now it has 47%. The production has increased, but in this situation, about 23,580. And then Chile, on the other hand, has a bigger part, and China also. So just another thing about lithium. All right, I'll move on to our lessons of the week, just in interest of time. As far as just, I like to look at long term. You can see this is inflation adjusted for the Dow from 1900 to present. And basically, you can see this is the long term, 123 years, but also we have a 14-year trend channel. So we hit the top of it, we came to hit the bottom, we went to the top, but now we're hitting the top of the long-term channel again. So the Dow has traded at or above long-term resistance several times in the past, including 1901, 1906, 1915, 1929, 1966, 1999, and 2021. You know, every time what has happened: 1929, what happened; 1999, you know what happened, and 1906, I recall, and I wasn't alive then, but we had a 1907 financial crisis, and 2021, again, we had a 2022 down market. So now we are going back very close to that, but let's see what happens at that. If we still have a little room to go up, but just be aware of that. As far as just so far total return, we look at the 2010 to now, as far as the trend, remember, after financial crisis, and where are we now? When you look at, obviously, you can see the Russell 2000, that the value is the worst performer, and then Russell as a whole, but the growth still positive compared to the value on the small cap. And again, after the 2022 down market, there's a big rebound, technical rebound, and there was a short squeeze as well. Money is coming back to these large cap growth stocks that we've discussed. So that's the reason you see the S&P 500 growth is outperforming everything else. So let's talk about this, again, the debt ceiling and what is happening, why Janet Yellen is concerned. So this is what the Treasury has to come up with the solution. Remember, they have all these large obligations they have to meet, and basically that's the concern. And you can see what is happening with this, and right around here, that's when on June 8th, that's when the Treasury will go to the deficit. So that's what the whole rush is. That there's emergency, they can create the funds, but that's the problem with they have to they will create illiquidity. So this is a rush that they're talking about. Also, again, I remember in 1980s talking about the debt ceiling, and this has been continuing. So today, the national debt stands at $31.7 trillion, or 120% of the US gross domestic product. I mean, you can see from 2010, after the financial crisis, and then, of course, we had the COVID. I mean, the slope, that's what I want to take a look at. I mean, this is huge. And once we look at, this is the total debt, and this is the debt limit, and that's what the whole discussion is. I mean, that's what they're thinking. And the US spends 6 times as much per senior as it does per child. And in 25 years, its spending on seniors will account for 70% of the old tax revenues. And this was Stanley Druckenmiller, I remember last week, was talking about. And the thought is, sooner or later, we have to basically confront this. And it's all about, again, cost cutting and as far as the benefits. So that's something that, it's just taking care of all the tax revenues will go to this, obviously. So the last but not least, I think this is, the last of this economic is the probability of the recession. Again, we looking at the as far as the spread. This was an interesting chart. I just want to look at, so you can see there's a 68% chance of recession by April 2024. And this is the highest we've been since 1983 as far as the spread goes. So every time we've gone up, we can see that we've had a recession. So over the past 70 years, a pause in rate hikes was followed by economic recession 75% of the time. It averaged lag of 6 months. So if in June, for instance, the decision is they're going to pause, according to statistics, then the December could be a likely time for a recession. Switching to everyone you talk to, of course, everybody's really hot on the trail of IA, and everybody's getting into this from Microsoft's of the world. IA, AI, artificial intelligence. So I just thought this is interesting. This was one of the hot companies, the Chegg Inc., and he was actually being on TV quite a few times, having interviewed in the last few years. And so I thought this is an interesting headline. ChatGPT claimed its first casualty. And this company does it tutoring, online tutoring, and textbook rentals. And from 2016 to 22, they went from 1.5 million to 8.2 million. And now every child you talk to, they want to do their papers, they're right on that ChatGPT. And basically, this is what has happened to the shares. I just want to show you the chart. The stock has plummeted 70% since ChatGPT launched in November. So this is where they were. And then last couple of weeks, this is, they've come from almost $30 to $9. So another thing, again, just food for thought. These what other companies will follow. This is a little chart that I use. So it's just like, and you want it's a relationship of the different asset classes and how things affect it. So obviously the central banks, just what Powell said, and I will show you how all of a sudden the things reacted when he was more hawkish, or it was very strong in his talk on Friday morning, and the market reacted. Of course, we talked about inflation, interest rates, we talked about economy, if there's a talk of recession, how the GDP is doing, or the consequence of each other, and how do they affect these. For me, these are the 4 major asset classes: stocks, bonds, dollar, and gold. And then geopolitics, I mentioned Ukraine, for instance. G7 is meeting now. Obviously, Ukraine is one of the major talks, what they're going to do with Russia. I mean, can you believe we are in the 15th month of this conflict, which is unbelievable, but it was predictable because it's, and I had talked, I think, in the beginning, Russia will not quit and Ukraine is not, those people, they don't give up. So governments, we're talking about the politics of the things, the debt ceiling, and of course I put down banking crisis. These are more recent things. So anyway, just pay attention to those. It was interesting. I saw this as far as the insider's transaction ratio that when we go basically above 20 or more, it's bearish. That means more selling. And when we are below 8 and then actually even more, that's bullish. So I just want to give you a list of, this is as of Friday afternoon. These are the list of the insider transactions and then the numbers, the higher numbers. This is based on numbers. It's based on value. So just, I'm not going to go through them. Just want you maybe have, if you're bored over the weekend, this could be a good research for you. All right, let me take about 10 minutes or so and talk about the few trades that I did last week and what was my thought process, why I was doing that. Number one, I keep repeating this, but there is a reason for this madness is these gap trades, and every gap you can see, we just fill it. I mean, especially smaller gaps. This is as of, like last Friday. So basically that continues. And as you can see on Wednesday, we had a really nice run. And then Thursday, we had a strong, and then Friday, we fizzled a little bit. And this is where the markets, this is where the Powell started talking. So I want to show you, this is my workspace, what the charts that I look at. And I just wanted to take a look at 8:30. This is S&P again, 5-minute chart. These are my ticks. And Powell started talking, and this is what the markets did. And look at what happened to the dollar and what happened with, consequently, this is my Russell. It was already negative to begin with. And then, this is where the speech started, right against this 20-bar moving average on the 5 minutes. This is the Dow, but also look at what happened to VIX. And again, I use a 20-bar. So it's all about the confirmations. And then look at the gold. So gold goes up, dollar comes down, and then the VIX goes up. So one thing, the day already started not in a great mood. So we did have, I'll look at the volume of the S&P and then as far as the spread, and then advanced decline. You can see right after that at 8 o'clock, 8:30, really, the whole thing, it started going to negative. So there were more issues declining than advancing. So what that meant, that don't be a hero, don't start buying, because there was a lot of pressure, and you can see that a lot of the ticks were in the negative. So this picture allows you to be selective on your trades. I'm also looking at the put call ratio, and put call ratio had ended at 0.8. So there was not a big panic either. There was not a lot of hedge. So that told us that, all right, if this is happening, then you want to just be cautious. And of course, we fill that gap. So when we also look at as far as the 5 minutes, for instance, And you can see I put this, that's when Powell started talking. We just broke, these are our moving averages that I use, the 8, 20, and 50. You see, I call them the bow tie. That, this one candle that told you that now that's distribution, and that might be a good time if you want to short the market. We already on the DMI, we were already on a negative DMI over positive, but also now you see the ADX is finding strength, and we had the trend, strong trend, negative DMI, broke below the moving averages, and all three of them, they were consolidating. So, and all the red candles. So basically, every time we went, we kind of rejected against the moving average, finally against the 50, you can see then we were consolidating toward the end. And the reason for this settlement was, again, positiveness about this debt ceiling and this Friday. So, so that's one thing I want to just, as a general mood of what to look for. So I did a trade on Wednesday, just small trade. And the reason I did this, just to share with you my thought process. Again, Wednesday, remember, we had a nice day up. So this is Wednesday. We had to fill that gap, if you recall, and then we had this nice run. So, and just remember these numbers. So basically, I just I shorted 5 contracts, and this was a very short term, and this was more of a just share it with you. So I had already covered 4 of them. So I had sold, and this was like about 462, but I had left one, and that was my runner. And when I took this picture, I was up on one contract about $212, and basically what I did. So you can see within 3 minutes, it hit my again my target. So I was in at 1140, and I will share with you why I shorted it, even though it was a positive day. Remember, this was a strong day, up day. Of course, this is my 233 tick. I'm under 200 bar moving average. I put my stop. It was not based on technical reasons. I had put my stop, and one cancels the other. Not one cancel. I'm sorry. I just put my stop. I want to have the runner just in case it will continue. Right on my break even. So I had that $412. So I was making the money. I was up another 212. I just want to walk away. I put it right here. Oh, it shows. You can see my buy stop was at 0. So I did not go with technical. I just went with actual dollar, because I just want to keep my 462 and just break even on my last trade. My thought was we probably will stay below that. But anyway, to make it short, it didn't. It stopped me out. And as soon as it stopped me, this is tick, by the way, it went down. So anyway, just that's how it is. But that's fine. So that was 4 out of 5. The other one was really flat. And so how did I come out with that? And as you can see, this is where I traded. If you can see, this is from the past. That's my the high of 16 minutes. It goes back. So generally, when we hit that, and we did hit it here, we do the first time we get rejected. So that was one of the reasons. This was my 1 minute. This is a 100-minute bar, which is 25-minute bar. Right here, you see that those moving averages, and basically that's where that was the reason I went short. Now, why did I take these quick ones? Why I didn't wait to go and more than that, more profits? And you can see it was not a bad trades, because after that, the things started turning around. So this is, we went down here, and then you can see we did go back up. One of the reasons I did not want to continue shorting it is because of, I'll share it with you here. Oops. Because of this, you can see the volume of the S&P, again, the advanced decline lines and advanced decline line. We had a lot of strength. I mean, you do not short these markets to stay in. I just wanted to use the, again, very short term, because we broke below the 100-minute, because also you see this 41.74. This is a CPI. You can see this. This was my CPI zone from way past. And look what happened. We did go and we got rejected. So that gave me the confirmation, but we still had strength below, and we did have, again, internal strength. So I'm not shorting it. I left that one just in case I was wrong and there was more momentum, but I was not convinced that it's going to continue. That's why I put it at the 0. I didn't want to take a loss. And the rest, you can see it came down and then it just stopped at the support. So I hope that's helpful. That was something I want to share with you. That's what I did. It was more of a kind of a lesson, and why, sometimes it's not about being, no, a lot of times it's not about being right. It's a business. So in 3 minutes, making 460, it's not bad. So I also had, as always, as you know, I have my Thursday's gold trade. Now, I generally take 5 trades. So I took, I think I took one before this. I took, well, this was a little later, came at in the morning. So I took it was a 181 calls. And you can see I got it like a 90 cents, and we got up to 2 cents. So I tripled some of that. And as always, I put my 25, 50, 100, and this one was a runner. But I did another 15 contracts. I did a 182, and I didn't have a good fill here. It was amazing. I was disappointed. I got a 5 fill at like 66 cents. And then I put a fill. It should have filled at 49. Whatever reason was, it went to like 60 plus cents. It was not, and I was upset because I did it. I did a 10 contracts here. So I had another 15 contracts. And for a while, I mean, I was losing money on it. But that's my, again, Thursday. Why did I go for this extra, as you called? I usually do 5 or 10 unless I'm pretty positive. There was a couple of reasons. Number one, or I would say 3. Number one was, if you recall, we had that 100-day moving average support. So I was pretty comfortable. I would say 4, actually. The second thing is, I've said it before, every time Friday mornings there's a major news, generally it favors the gold because of the volatility. Not 100%, but 75%. If you have looked at some my gold trades in the past, the big winners, they usually have been like the day before. For instance, there's NFP numbers coming, or like the Fed chairman is talking, some kind of event. So that was my other things, anticipating is going to be a move. The third thing is this whole move on Thursday, and I want to remember this because I want to share another trade based on that, was all this optimism that, the whole House and Senate, they're coming together. This is the end of it. There was too much sugar for me. So basically, that was another reason I went with, which actually we ended up tripling on this as well. So you can see I did actually 10. I sold at the market when we hit right around here, and I was done. 10 of them I sold it. So we were at like 178, and I bought them at 60 something. So it's almost tripled. So it was not a bad day for that. But another reason I had, and I got into the additional one, what you could see on a 10-minute with the clouds, and you're not supposed to buy, but that's why I want to give you my first 3 reasons. We were really consolidating around this time. And of course, you see the next day what happened. So I want to share this, especially for newer traders, which we don't have, but a lot of new traders, and even some seasoned traders, they have a feeling or they have emotional attachment. They come out with the reasonings. There's a difference between emotion and a gut feeling. The gut, and that my apologies if I shared before, your intestines have the second largest number of nerve endings or nerves, and after brain. And what it is, it registers your experiences. So whether you're athletic or whether you've done any type of analytical things, that's where you sometimes you get a feeling about someone you meet or in a relationship or in business. We call it gut feeling. Gut feeling is not a random thing which is, justifying, I feel good about this, let me do it. No, you have because of the years and years of experience. So that's what it becomes, again, subconsciously, you have your mind set for you in a sense. So you don't even think about it, like sports or scoring goals in soccer or driving. So the same thing here. So what I had was, it's just when there's a euphoria about something, usually it needs some time to digest. So my thought process was the following Friday, or which is the next day, things are going to settle down, especially Fed was going to talk. So that's one of the reasons I chose to go long with gold. But also another thing I did, it's right before the market closed, that actually it was 12:57 or 56 or 57. I bought some puts on SPY, and my thought process again was precisely what I said. Of course, it's like 3 minutes to go, so I just want to pay as little as possible, just the last second. And it was a Friday's expiration, and of course, Friday mornings the market's open, and I'm losing money. But I knew Fed, Chairman Powell is going to start talking. And he started talking, and this is what happened. And it just filled on the last one was at 100%. And that's what, it was a nice day as far as buying puts on SPY. The good thing about options, which is obviously different than futures, it is you have that luxury of, being patient. With futures, I mean, if I had the shorted futures, this probably would have been stopped out. And the options give you that certainty, you know exactly how much you're going to lose. Futures, unfortunately, things can go wrong and your stops might not get hit. I mean, but with options, you know exactly how much is at risk. So anyway, I hope that was helpful. My apologies if it took a long time, but I thought it was imperative to share that with you. Quickly, I'll go ETF of the week. Obviously, we talked about Russell and the banking. The KRE was up 9.1%, the best performer. The miners, gold miners, were the worst performers. They were down 5.3%. The semiconductors also did well. They were up 8.5%, but then the junior gold miners were down 5.1%. I mentioned about Turkey last week. That was our ETF. I said, well, just watch for it. This is where we were. And then this is where we are. The markets didn't like it. There was no certainty. They were hoping actually the opposition could do much better. And there's, again, irregularities. So they have to wait another week now. Or it was 2 weeks then. So you can see we're down about 10% in Turkish ETF. I mentioned about the Japanese markets. So this is the ETF, the biggest one. We got few actually. They have the small caps, but EWJ is the largest and most famous and the oldest ETF. So this is where we are. We can see we are above the 20 exponential moving average, 50, 200. One word of caution at this time, although again, you can see the relative strength compared to S&P is very good, very stronger than S&P, is we're getting a little too far away. You can see that 20 bar moving average or 20-day moving averages it has a big gap above the 200. So generally, when we run away from the moving averages, we like to come back. Like for instance, we really had a nice move, we come back, kiss it, and sometimes come to the 50. If sometimes even go to 200. So just be aware of that. Just again, more of education, so you have it handy. The last few minutes, I want to just a couple of, well, one stock. We talk about seasonality. I think I mentioned it a couple of weeks ago. But this is that diabetes, medical tools, the Dexcom. From 24th of May, which is coming up next week, to July 23rd, this stock for the last 13 years has not lost money for that period of time, 2016 and in 2021. It has gone almost 30%, above 30%. So it has been up 13 years in a row with average of 17.17%. Just a food for thought from the seasonality. This is their chart. We are sitting right on the 50-day moving average. So nothing else. I mean, you can do your own research just based on seasonality if you want to pursue it a little more. I've been doing Tesla for about 4 or 5 weeks. I thought it would be nice to just have this continuity. Every week we want to visit that. Remember, we started doing this when the earnings came, and the thought process was we gapped down. Now, the question was, where do we go? And we were right inside. We gapped down to the bottom of the cloud. But I went back to January and I mentioned, usually Tesla has not been filling its gaps. You can see there's gaps there. We have big gap from October of 20, for instance, 2019 actually. So, but it allows you to set up your actually support and resistance. So this was when it gapped up. So that was my at that time I want to put this zone. This was this whole gap. Usually when it opens up, it becomes your support. So when we gap down, we did go down, and if you can see, we did break it just a little bit, and then we bounced back. So we've been hitting our head against a rising kind of cloud. So since that was at 154, we hit it, and we are at like 180. So we just continue. We're broken above the standard and trend line. You see the DMI positive has taken over. And basically now the next target could be the lower edge of this cloud, which is pretty thin, so it can easily be broken. So there's that positiveness. And what you can see, this blue line is basically now the top of our last gap, this most recent April reporting. And you see we went below it, but then we bounced back. And so it's just a little bit of analyzing how the gaps work. You see our trailing line is basically inside the cloud. So once it goes above the cloud, that's another positive thing. So we are above the trend. If you break above this cloud, this goes above this cloud, and they're all good to go. But right now it's positive, short-term positive to neutral. So, but just want to follow that. The last couple of things is our squeeze is this S&P small cap 600 with their technical analysis ratings and the setup and the fundamental analysis. So can follow that. We still got some interesting earnings coming up. We are almost done with most of them, but I would pay attention. There's Zoom that I'm doing, the Zim and Zoom, Lowe's, Dick's, Intuit, a few more retailers again, like Kohl's, and then Best Buy, Costco. You see Big Lots, and again, that's a Gap and Deckers and Restoration Hardware, a lot of retail, and we want to see the consumers' behavior and what their projections are into it. So these are the high volatility stocks, from Kohl's to Gap to Children's Place. So pay attention to that. This is a little more analysis. NVIDIA is the biggest one I mentioned last, earlier. Again, with this, with their big influence with the AI, and also there was tons of options being bought on Friday. So just letting you know, it's coming on Wednesday. So then the Palo Alto, another one, the Zim, Lowe's, Dick's, and Zoom and Costco. So, all right, I appreciate it. I hope it was informative. I thank you so much for being part of this. I'm gonna stop the recording and open up for Q&A.